In our previous video, we had taken a closer look at some examples of potentially using velocity banking to pay off credit card debt. Well, in today's video, we're going to take a look at another example of using velocity banking to pay down credit card debt, but this time we'll also incorporate another popular banking strategy, which is using a 0% balance transfer that many banks offer for a set period of time. If you don't have a good idea of how velocity banking with the credit card works, I first recommend watching our video on this exact topic before watching this one. We'll leave a link down below in the description. For those new to the channel, welcome to Concepts Made Simple, where we aim to simplify everyday financial and self-improvement topics. If you enjoyed this content and you're looking for additional content related to velocity banking and everyday finance, please consider subscribing to the channel down below. For comparison's sake, we're going to use the same numbers in terms of income, expenses, and credit card debt from our previous video, which went over a case study of John and how much he could potentially save in interest through using velocity banking to pay off his credit card. To quickly summarize, John had a monthly income of $8,000, $7,000 in expenses, and $20,000 in credit card debt. Our case study found that if John stayed consistent with velocity banking, he would be able to pay off his credit card in approximately 22 and a half months and pay around $2,441 in interest. We found that this would allow John to pay off his credit card 2 months faster and save around $1,093 in interest. Now, let's take a deeper look into this scenario, but see what the results would look like if John had used a 0% transfer balance offer from a bank. Let's imagine that John finds an offer that allows him to transfer $20,000 in credit card debt to a new card that has an offering of 0% APR for the first 18 months. Up front, John will need to pay a transfer balance fee of 4%. These types of balance fees are typically between 3 to 5%, meaning he will owe the bank $800. Since John has a monthly cash flow of $1,000, this means this $800 will account for 80% of his first month's cash flow. Next, John will put velocity banking into action using his new credit card with 0% APR for the first 18 months. Of John's $7,000 in expenses, $5,500 are eligible to be paid onto his credit card. So John will allocate this $5,500 and his monthly cash flow of $200 onto his credit card. John's monthly cash flow is lowered for this first month as he needs to pay the transfer balance fee of $800. This will lower John's balance to $14,300. Now, throughout the month, John will pay his $5,500 in expenses as they come due onto his credit card. Now, since John has 0% APR for the first 18 months, lowering his average daily balance is not as relevant during this promotional period. However, by still using his credit card to pay his expenses, John can still collect his credit card rewards. In John's case, his new card offers 0.8% cash back, giving John an extra $44 monthly, which he can then use to pay down the balance on his card. After 1 month of using his new card, John's credit card balance will be equal to $19,800 minus his $44 in cash back, leaving him with a total of $19,756. Now, it's important to remember that John needed to pay the $800 balance transfer fee, causing him to have minimal impact on his balance during this first month. If John is then able to stay consistent with this process, at the end of the 18-month period, he'll be left with a credit card balance of approximately $2,632. After this 18-month period is up, John's card will carry an APR of 24%. This is often one of the negatives to credit card transfer offers, and that is that they typically come with much higher interest rates after the promotional period is up. While using velocity banking, the remaining balance can be paid off in full in approximately 21 and a half months. During the 2.5 months where there is a 24% interest, John will pay roughly $30 plus in interest. This number is very low because John was able to stay consistent, but if John had racked up additional debt during the 18-month period, it could be a much different story. Now let's compare these numbers to our two other scenarios, which are if John was just using velocity banking without the cash transfer, and our other scenario, which is if John was using his monthly cash flow of $1,000 to pay down his debt. First, if John had used his monthly cash flow, it would take him around 24 and a half months to pay off his balance, and he would pay around $3,534 in interest payments. With Velocity Banking but no card transfer, it would take John around 22 and a half months, and he would pay around $2,441 in interest. And lastly, with using Velocity Banking and the credit card transfer offer, John would be able to pay off his credit card in about 21 and a half months and would pay about $30 in interest, plus the initial $800 fee that allowed him to transfer his balance. This is 3 months faster than our first scenario and 1 month faster to our second scenario. In terms of overall interest and fees, John would save around $2,704 compared to just using his cash flow, and $1,611 in savings compared to using Velocity Banking without a balance transfer. As you can see in this example, taking advantage of the 0% APR on transfer balances can be advantageous. But it's important to keep in mind that there are reasons why banks still offer this type of promotion. Banks are aware that for many individuals, their core habits won't change after transferring their debt, meaning they are likely going to find themselves running up high balances again, and once the promotional period is done, they will typically be stuck paying a much higher interest rate than before. As well, Dave Ramsey commonly points out that doing a balance transfer can lead you to feel like you've accomplished something with your debt. And if your money troubles have stemmed from psychological issues in the past, this can potentially be very risky. And lastly, the same is true with using Velocity Banking with your credit card, and that is you're opening up additional room on your credit card that is meant to be used to pay for your expenses. But if you lack discipline, you could end up spending this on other things. Thank you for watching today's video, and if you found the content to be helpful, it would be greatly appreciated if you could leave a like on this video and really consider subscribing to the channel for more content related to Velocity Banking and everyday finances.